Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So we're getting into the hottest time of the year down here in West Central Florida. And this is the point where everybody starts to dream of a cool front. And I guess with the heat dome that was recently parked over a big chunk of the U.S., a lot of you are looking forward to the next cold front. You know, it's always kind of funny when the first real dip of cool air hits down here in Florida. It's usually in October, and, you know, it goes down to like 59 degrees, and suddenly you learn that all of your neighbors own hoodies and boots. And yes, I said 59 degrees, and you're right, that's not really cold, but after 5 months of 90 plus degree days, and I mean every day, 59 feels downright frigid. So it's a matter of relativity, right? You know, sometimes things that aren't extreme seem extreme because you're coming off of another extreme. And I think that's kind of what's happened with the gold market through the first half of this year. So I'll talk about that a little bit, and also talk a little bit more about Federal Reserve Chairman Kevin Warsh and the persona that he is trying to put off, and whether or not that's going to really work in the real world. Before I get to all of that, of course, as always, thank you so much for listening to the show. I really do appreciate it. I'm sure that you can hear in my voice I have very little left. I'm battling some kind of creeping crud that I can't seem to shake. So we're going to power our way through this podcast. I do apologize for my voice. It's the best I can do. We'll see if we can get all the way through it. That's the goal. But again, thank you for listening to this show. I appreciate it. If you would do me a favor, go to wherever you listen to the podcast, whatever platform you happen to listen on, and write us a good review, and give us those stars and thumbs up, and maybe even share the episodes on your own social media channels. Those kinds of things help, they tweak the algorithms and help grow the show. So if you would do that, I would really greatly appreciate it. So it feels like gold has really tanked in 2026, doesn't it? But it's kind of like the temperature story I told a few minutes ago. The drop in the gold price seems extreme because we came off such an extreme rally to kick off the year, right? In reality, while gold is down a bit, it's not nearly as much as you might think. And despite the steep correction and increased volatility, gold actually remains one of the best performing assets over the last 12 months. So, how much do you think gold has dropped since the beginning of 2026? 25%? Nope, lower. 20%? Nope, lower. 15%? Nope, lower. 10%? Nope, still lower. The answer is 7%. That's all. I know it feels like gold has gone down a lot more because, as you might recall, gold started the year with a bang, hitting 12 all-time highs and pushing above $5,000 an ounce in mid-January. So those first 2 weeks, gold was going gangbuster, and then we had the correction. And then after a brief spike at the beginning of the U.S.-Iran conflict, gold has been generally range-bound between $4,000 and $4,500 an ounce. So since the record highs of early January, gold is down nearly 30%. That's what you're feeling. But much of that 30% was added the first 2 weeks of the year in that crazy run-up just weeks before. Gold's volatility spiked to over 50% early in the year. I mentioned that volatility. That's a part of the equation too. And it has since moderated to around 30%. However, we're still seeing a lot of volatility in gold. It's still far above the 20-year average of around 17%. So still a lot of price volatility out there. And that makes sense because we have these swings with, every new piece of news that comes out about the Iran conflict or, whatever the latest job report was. Speaking of job reports, the last one for May was not great, or June, I should say. And actually, they revised some of the May and April numbers down as well. shocking. I know that's what the BLS does. But, the mantra has been that the job market has been really strong. And I did a breakdown. I kind of went through all of the numbers. I used May's data, not June's, so it's a little bit outdated just in terms of the actual numbers, but it gives you a sense of what the BLS has been doing and why these job numbers are so wonky. And I kind of took a deep dive into it. I looked at, the people that are working part-time who don't want to, the people that are working extra jobs. When you start factoring all of that in, it makes the job numbers look a lot different than the spin that you get from the mainstream media. I'll link to that article on the show notes page because it's definitely worth checking out. I think among the things that are really driving the gold price right now, the perception of the labor market is one of the significant ones, along with the Iran conflict, and then also the perception that the Federal Reserve is going to be very aggressive in tackling inflation and keep interest rates higher. So those job numbers are important. It's important to understand why you should take what you hear on Fox Business and CNBC with a grain of salt, because you're not getting the full story of what these job numbers are really showing us. But anyway, so we've had a lot of volatility in the gold market. And as I mentioned, even with the correction, gold has still outperformed most assets over the last 12 months. If you go back to this time last year, gold is up around 33% from that point. The only asset class that has performed better than gold over the last 12 months are emerging market stocks. The yellow metal is still ahead of U.S. stocks, of commodities, of U.S. bonds, cash, and gold itself has outperformed a balanced portfolio. So I think it's important to put that in perspective. It's a little bit of a reality check because I think we often get caught up in recency bias, right? We feel like gold has just really struggled and gold is doing really awful. And I think there's some negative sentiment out there, especially in the U.S. markets. So it's definitely something that you should keep in mind. And of course, the sell-off has led some pundits to declare that the gold bull market is over. But it's important to remember that corrections are normal and they're healthy during a bull market. You should get them. Nothing goes up in a straight line. And really, that massive run-up that we saw in the first 2 weeks of the year, that was kind of out of character as well, right? That was an anomaly. And so the correction is really just kind of putting things back into kind of resetting things back where they should be for that gold bull market to continue. Now, in the short run, gold continues to face headwinds, and I think it's going to continue to face headwinds in the near future. I'm short-term bearish, long-term bullish on gold. And I've already mentioned a big part of this is due to the expectations that the Federal Reserve will maintain a tighter monetary policy to combat price inflation. And, I feel like I've run this subject into the ground. I talk about it frequently, almost every show. I probably mention this, but I have to, because this is the thing that seems to be driving the gold market right now. This perception of a higher interest rate environment, that is the only reason that gold has failed to rally back after the correction. The mainstream prognosticators seem to be ignoring the massive debt black hole and the difficulty that it creates for the Fed. I've said this over and over again. A debt-riddled bubble economy does not function in a higher interest rate environment. And we're going to dig a little bit deeper into that because we're starting to get a little bit of a feel for how Kevin Warsh is going to run the Fed. And I think his rhetoric and his reality aren't going to quite mix. But we'll get to that in just a second. I want to just go a little bit more of the data that's come out for the first half of the year in terms of gold. Now, the World Gold Council analysts say they think that the current gold price is in line with the current economic backdrop of, quote, moderate growth, cooling but still elevated inflation, and expectations of further but limited central bank tightening. So kind of what they're saying there is that the correction kind of brought the price down where it is about where it should be, given the the expectations in the economic environment it is perceived by the markets. Now, again, I think the markets are misperceiving that a bit, but we'll get to that here in just a second. The World Gold Council says under these conditions, gold will likely stay relatively range-bound, plus or minus 5%. And I think that's probably a fair accurate. Again, I'm kind of in that bearish mode for the short term as well, until people realize what the debt black hole is going to do, how it's going to impact the economy. Until the markets realize that the Federal Reserve is not going to be able to hold rates higher for longer, I think we're going to see this range-bound price action with a lot of volatility, especially until things settle out with this Iran conflict. The World Gold Council, they went on this. I'm going to read this as a little bit of a longer paragraph, but I think it gives a pretty good summary of how that organization sees the gold market right now. Quote, on the upside, clear catalysts, a worsening economy or renewed geopolitical shock, a shift towards lower interest rate expectations, or a wave of dip buying could reignite gold's momentum and lift it back towards the $4,500 an ounce mark or above. If the signals are strong, gold could push even higher. Conversely, an environment of resilient growth, rising yields, and calmer markets could see gold slip further, though a fall of more than 10% from the current levels may be tempered by bargain hunting demand. Meanwhile, enduring central bank demand and policy shifts in key markets like India are additional wildcards that could subtly influence gold path in the second half. So, you'll be shocked to learn that I think the first scenario there will be the one that plays out, the worsening economy and the shift toward lower interest rates, which those two things go hand in hand. And this is why I'm pretty convinced the gold bull market is just fine despite the recent headwinds. It's also why I think the lower prices right now provide a buying opportunity. And I've said that often in past shows. Now, you might be thinking, I wish. I can't really afford to invest in gold right now. I'm barely paying my bills with my paycheck. Well, Money Metals has a solution. We have a monthly purchase plan, and for as little as $100 a month, you can build a precious metals portfolio over time. It's kind of a set it and forget it thing. So each month, we'll withdraw that $100. You'll get $100 worth of gold, and it will accumulate over time. And it's a great way to build a portfolio. Especially if you don't have $4,000 or $5,000 to drop on an ounce of gold, or even a big chunk of money to drop on silver, you can do it through the monthly purchase plan. There are certain products that are available through that, and if you go to moneymetals.com, just go up to see programs, and you'll find it right there. I'll also link to it on the bottom of the show notes page, but definitely something to check out. Also, make sure you check out our specials. We're always running some good specials, and you'll see those on the top toolbar over at moneymetals.com. So check that out when you get a chance. So I talked a little about the new Federal Reserve Chair after the first FOMC meeting a few weeks ago. And since then, it's pretty clear that Kevin Warsh is bound and determined to make sure absolutely, without a doubt, he is not only going to kill inflation, but he's going to grind it into the ground, or at least get it back to that 2% target, the preferred rate of monetary debasement. But he's very emphatic. And I got to give it to the man. He talks tough. He's a tough talker. The question is he willing and able to back it up when things get hinky? So Warsh recently appeared at the European Central Bank Forum on Central Banking. This was last week. And as I mentioned, Warsh emphatically insisted he is committed to getting inflation back to that 2% target, period. End of story. He said, if there were people in household or business sector in the financial markets who thought that this central bank was going to be comfortable with an inflation objective above 2%, well, I guess they're going to be disappointed. He said, we are going to deliver price stability in the U.S. And he has echoed this message over and over again. Inflation is the priority. We're an inflation hawk. We're holding interest rates higher for longer. Now, Warsh also refused to hint at what the FOMC might do at the July meeting. And this is another thing that I think is going to be a standard that we'll see from the Fed moving forward. Warsh isn't going to telegraph what he's doing like Jerome Powell did. Jerome Powell was very fond of what I like to call open mouth operations. He would run his mouth and markets would adjust. And Warsh doesn't seem inclined to do that. He seems to want to keep us guessing, right? Not telegraph, not do what has often been referred to as forward guidance, right? You're just going to find out about it as you go. This is going to create more market volatility. Markets like to know what's coming. They like that certainty, and Jerome Powell definitely delivered that. It looks like Warsh is not going to, although we'll see, because it could be that in his communication style, he'll still be telegraphing things, because that's really how central bankers work, right? Open mouth operations are extremely important, because really there's not a whole lot that they can really do when you get down to it, right? They can tinker with the balance sheet and they can tinker with interest rates. That's about it. So they depend a lot on your perception, and they want to shape that. So still kind of learning how Warsh is planning on doing that. But one thing is certain. He wants to be less transparent. And the other thing that is certain is he wants you to know he is an inflation hawk. And the hawkish talk has put a significant drag on the gold and silver markets. Just a few months ago, virtually everybody expected another rate cut this year, and sentiment has now completely flipped, with most people expecting a rate hike before the end of the year, maybe even 2 rate hikes, and at best, a Federal Reserve that is going to continue to hold interest rates at this higher level. And, they're not really high right now, but given the amount of debt that we have, government debt, corporate debt, consumer debt, all of that debt floating around out there, they don't like high interest rates. So given the economic situation, the interest rate is very high, even though from a historical standpoint, it's actually historically low. And we are historically still in a loose monetary environment, which is something that I like to emphasize. We've been in a loose monetary environment historically this entire time that the Fed has been battling price inflation, which might tell you why we still have significant levels of price inflation. No, it's not just about oil, right? So the narrative is, since gold is a non-yielding asset, a higher interest rate environment is considered a bearish setup. That's why gold has been trading sideways for the last several months. That's why we've had the big sell-off since the beginning of the Iran conflict. That's why we are where we are. And as I said, I think we're going to continue to be kind of mired in this setup until people start to see that this setup is not sustainable. This is not reality. Until we get that reality check, that thing in the economy that signals you're going to have to cut interest rates, we're going back to inflation, I think we're going to be kind of seeing what we're seeing today. So again, Warsh seems to have the will to tackle price inflation. But what happens when his will clashes with reality? What happens when that reality check comes? What happens when the stock market crashes? What happens when there's some kind of financial crisis brewing? When unemployment spikes, right? What is the Fed going to do? You see, no matter how much Warsh wants to tackle inflation, the path isn't as easy as he seems to make it, or he seems to want us to think it is, right? The central bank doesn't raise interest rates in a vacuum. And Warsh and company must contend with the debt black hole and an economy that's dominated by bubbles and malinvestments that were incentivized by decades of easy money. And that easy money hasn't really been taken away. As I said, we're still in a relatively easy money environment, but we're definitely in a tighter environment than the drug addict would like, right? The heroin is not flowing as the addict would like. The addict is not nearly as high as he wants to be. And the mean old drug pushers is limiting the supply. And, what happens when a drug addict doesn't get his drugs? Well, at some point he starts going to withdrawals. And withdrawals are very painful. A withdrawal in the economic sense is a recession. And ultimately, that's what's going to happen if the easy money drug isn't returned. Now, what happens if you keep giving a drug addict lots of drugs? Well, he overdoses. So you can see, either way, you've got a problem, right? This is the catch-22 that the Fed is in. This is the tightrope that the Fed has been walking for so long. And right now, because of the economic situation being what it is, Warsh can afford to talk tough about inflation. That's the thing that everybody's worried about. And there aren't any really obvious signs. They're there. But there's not any obvious signs that the economy is strained. It is, but again, it's not obvious yet. And while it's not obvious, you're going to continue to hear this hawkish rhetoric from Warsh. Again, simply put, the economy is addicted to artificially low interest rates and money creation. And sure, Warsh can take the drug away, but again, the addict's going to go into withdrawals. So it's got to have to choose. It can tackle inflation. Warsh could do it. I think to do it, he's going to need to hike interest rates much higher. I think he would need to shrink the balance sheet. Remember, balance sheet reduction is not happening right now. Right now, the balance sheet is actually increasing. We're seeing quantitative easing. We're seeing money creation, despite the talk about being hawkish on inflation. But the Fed could do it. He could do it. But it would pop the debt bubble and topple the economy. Or the Fed can try to keep the economy limping along with looser monetary policy. And the Fed can respond if we start seeing shakiness in the economy with more loose monetary policy. It can't do both of those things. It can't simultaneously support the economy with stimulus and fight inflation with tighter monetary policies. It can't. It's not a thing. So, one could argue that Warsh is right to draw a line in the sand when it comes to price inflation, and that the pain is necessary to unwind the last 20 years of monetary malfeasance. I would agree with that. If I was a Fed person, I would never be a Fed person, and I don't think there should be Fed people, right? I believe that interest rates, the price of money, should be set by the market, not by some technocrats with calculators and slide rules. But the world we live in, we have a Federal Reserve. If I was part of the Federal Reserve, I would crank those rates up. I would deliver the pain necessary to really tackle inflation, because ultimately, over the long term, inflation is strangling the average person. However, inflation is easier to hide, and it's easier to put the blame for inflation on other entities, right? We know that the Federal Reserve and the government is what causes the inflation with its constant money creation. That is definition of inflation. Rising prices are a symptom of that. But it's easier to blame greedy corporations or Putin's price hikes or, unicorns, right? Oil, all of these things that aren't really causing inflation, they can blame that and kind of hide the blame themselves. It's hard to hide a crashing economy. So from a political standpoint, politicians and central bankers tend to take care of the economy first, worry about inflation later, right? We actually heard this rhetoric come out during the pandemic. Yes, this is extreme monetary policy. We've got to deal with the crisis, and then we'll worry about the aftermath down the road. That's how central bankers think, right? So what I'm getting at here is that the pain that would be necessary to unwind the last 20 years of monetary malfeasance would not likely be acceptable. Voters get unhappy with economic pain very quickly. They get unhappy with inflation, but again, it's a little bit easier to pass the blame on that, right? Politicians don't like unhappy voters. So you can see the problem here. So yes, I guess kudos to Warsh for his apparent commitment to price stability, but he seems to be ignoring the political realities. And I'm not the only one out there that thinks this. I ran across an interview with a Brad Dunkley, and he is the CIO of Waratah Capital Advisors. And he was interviewed on Kitco News. And he said that the long-term gold bull market remains firmly intact because policymakers have, quote, abandoned the idea of allowing recessions or prolonged economic downturns. So he's driving at this same point that I was just making, that there are political realities that have to be navigated as well. And policymakers have navigated right away from allowing recessions or prolonged economic downturns. Now, as I've already alluded to, recessions are painful but necessary, right? They clean out malinvestments and resource misallocations resulting from monetary miscalculations. So you get artificial monetary policy, you get artificially high interest rates or artificially low interest rates. Either way, it creates distortions in the economy. Recessions clean those distortions out. But recessions also upset people, and politicians don't like upset people. So instead of letting recessions play out, they turn to stimulus in an effort to reinflate the bubbles and ease the economic pain. This effectively kicks the can down the road and sets the stage for a bigger bust in the future. Now, you're probably thinking to yourself, well, that's not a very good way to run things, right? You're kind of cutting off your nose to spite your face. You're just pushing things down the road. You're not solving the problem. But you're thinking like a regular person and not like a politician. The politician isn't thinking 10 or 15 years down the road. The politician is thinking about the next election cycle. At most 4 or 5 years down the road, more likely 1 or 2 years down the road. So they're more concerned about you being happy enough to vote for them again than they are for doing the things that might be painful to make the world a better place 10, 20 years down the road for your children. They don't care about that because they're not going to be in office anymore. Let the next guy deal with it. So this creates a vicious cycle. Each monetary intervention increases the size of the bubbles and the malinvestments. That means they have to implement bigger interventions to keep the bubbles inflated when the economy starts turning sour. The pandemic was a perfect example of this phenomenon. The economy was already shaky, and then in late 2018, the stock market crashed. By the end of 2019, the Fed had cut interest rates 3 times, and they had relaunched quantitative easing. They bailed it out, right? The pandemic gave them the excuse they need then to double down on the monetary stimulus. They cut rates all the way to zero and then launched nearly $5 trillion in quantitative easing. So in effect, I can't talk. I'm sorry. In effect, the pandemic pushed the economic reckoning into the future, and that future is quickly approaching. I say this a lot. I think it's kind of clever. You can play kick the can down the road, but eventually you run out of road, right? That's going to happen. We still haven't reckoned with the economic fallout from the COVID era. And in fact, we've never reckoned with the impact of nearly a decade of easy money following the 2008 financial crisis. We were starting to see those recessions, that correction in 2018, and the powers that be started to try to bail it out, and then they got the excuse from the pandemic, and they just doubled down, tripled down, quadrupled down, whatever you want to say it. So this is the environment that Kevin Warsh has to navigate now as the Fed chair. And Dunkley said he thinks that despite all of the tough talk, a Warsh-led Fed will ultimately follow the lead of previous regimes. Quote, "The debt is too high, so they can't let interest rates go up. They're just going to run it hot. They're going to print money." I agree with them. This is not what Warsh is saying. This is not what most of the markets are anticipating, but I think this is the reality. They're going to print money because that's what they do. Dunkley went on to argue that people buying Warsh's rhetoric and expecting restrictive monetary policy to dominate underestimate how quickly the central bankers will reverse course if the economy cracks and the stock market goes into a free fall. Quote, "They've shown us time and time again, no pain is allowed. No recessions are allowed to happen. Unemployment is not allowed to happen. Bad things happen? Well, just we'll send you money. Go spend it, everybody," right? Stimulus, that's the solution. We saw it at the dot-com bubble. We saw it in the 2008 financial crisis. We saw it during the pandemic. What reason do we have to think that Warsh is going to be a different animal, right? Now, not necessarily an economically wise strategy, but it's the only choice politically. People turn on politicians quickly during economic downturns. And again, since politicians are driven by short-term incentives, getting reelected, allowing the pain to continue is not an option. Dunkley has hit the nail on the head with his thoughts on this. And don't think for a minute the central bankers aren't political creatures, right? Warsh can tout Fed independence as loudly as he pleases. Jerome Powell touted Fed independence. We all talk about Fed independence. His words don't make it true, right? His words don't make it true. Looking at the bigger picture, Dunkley said the short-term price pressure due to the oil shock isn't the Fed's real problem. He said the real issue is structural monetary debasement. In other words, depreciating the currency. He said governments have become dependent on maintaining negative real interest rates to support growing debt burdens driven by relentless borrowing and spending. This, Dunkley said, has become the dominant driver behind the gold bull market. And he went on to argue that while perception of a hawkish Fed has driven a sharp correction in the gold market, the long-term bullish trend remains fully in place, with the current environment creating, quote, a powerful tailwind for the metal. He said that no matter what they're saying today, policymakers will ultimately suppress real interest rates rather than allow a tight monetary environment to spark a debt crisis. I think he's absolutely correct here. I think he's spot on. You see, what's the problem is that a lot of folks that are out there in the economic punditry sector, the government sector, they're not thinking about trade-offs. And that happens a lot, right? They think about a policy and they only think about the one aspect of it. Well, we have inflation, so we're going to keep interest rates higher. And they don't talk about the fact that if we keep interest rates higher, there's a trade-off in that we have all of this debt that has to be serviced. It's increasing the cost of debt, right? It's making it more difficult to borrow. It's potentially contracting the economy. There's a trade-off there. If we decide to stimulate the economy to boost it, then there's trade-offs. The trade-off is inflation. You have to think about the trade-offs. Warsh's commitment to slaying inflation would create significant pain. Is he really willing to face the fallout from the trade-off? Now, no doubt the new Fed chair talks the talk, but can he walk the walk when push comes to shove? Previous Fed chairs could not. Even Alan Greenspan, who is a vocal gold bug, a sound money guy, he turned into a money printer when faced with a tanking economy. He laid the stimulus on. He set the stage for what we have today. Alan Greenspan, he talked the talk too. So don't think just because Warsh can yap, that necessarily means he's going to be different than the other Fed people. He might be. But when I look at history, I tend to think the history, if it doesn't repeat, it often rhymes. And until I have a clear reason to think that Warsh is truly going to be the hawk that he's advertising himself to be, I'm not buying it. I think he's going to be a dove just like the rest of them. I think we're going to have more inflation, more money creation, and ultimately we're going back to a big dose of quantitative easing and 0% interest rates because this economy is broken. And the only way it can survive is with the monetary heroin. That's where we are today. And I don't guarantee much, but I will guarantee that in a year, your dollar is going to buy less than it did today. Your dollar is going to depreciate by at least 2%, probably more than that, probably a lot more than that. And you should be prepared for that. If you are saving in dollars, you are losing your wealth slowly over time thanks to the monetary malfeasance of your government and your central bank. This is why you need to hold real money. You need gold and silver. It's why I say every week it's a great time to talk to a money metals, precious metal specialist, right? Gold is down roughly $1,000 from its all-time high. At some point, it's going to get back to that all-time high. So this is a buying opportunity, in my opinion. Now, you could listen to this and think, Mike's wrong. The Fed is going to be tough on inflation. Warsh is the new sheriff in town. Everything's going to be fine. And you might be right. I don't think so. But look at the evidence for yourself. And if you're worried about preserving your wealth, then don't put it off any longer. Talk to a precious metal specialist at Money Metals. Call 800-800-1865. If you're not somebody who likes to talk on the phone, that's cool. You can go to moneymetals.com and talk with a precious metal specialist in a chat. Or, if you know what you want to get some gold maple leafs or some gold bars, you can just go right to those products. You'll see the product pages. You can order online, pay online. We'll ship the metal right to your home. Or, of course, you also have the option of storing your metal in our state-of-the-art bullion depository in beautiful Eagle, Idaho. But do it today, right? Money printing is not ending anytime soon, no matter what Kevin Warsh might say. So, that is a wrap for this episode of the Money Metals Midweek Memo. You can get more information about the things that I've talked about on the show today and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up and get on our email list. Of course, you can subscribe to the Midweek Memo podcast on your favorite platform. And when you do, you'll also be able to tune into our Market Wrap podcast, which airs every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. Thank you so much for listening to the show. Thank you for tolerating my wonky voice. It has gotten better through the course of the show, so I guess that's good. But thank you again for listening. I appreciate it, and I'll be back again next week.